in the last session, we covered accounts, some benefits of using an IRA. So hopefully you're to the point where you've decided, hey, I'm going to do this. But now we need to talk a little bit more practical. How do you actually put it to work? How do you put these investments together? How do you actually do them correctly with a self-directed IRA? So my goal in this session is to get you guys comfortable and confident that this can work for you. So the goal is, again, to get you guys comfortable, confident, hey, I can do this, I know how to put it together. I'm going to talk about ways people have put investments together. I'm going to try to speak very specifically on those things. You should still be working with an attorney if you're putting together a real estate investment, though, right? You shouldn't just take the guy on stage's interpretation of what's happened and put it together, and hopefully that works for you. You still should be working with an attorney. I'm not an attorney. I'm not an accountant. Thankfully, we're not really going to talk about taxes in this one, save for one minor part. But this one's more so going to be focused on how do you execute your investments. So nothing here should be construed as legal advice. Sound fair? All right. I'm going to cover some basic underlying principles that govern pretty much all IRA investments, including those that you may have at your more traditional firms, but they really don't come into play so much until you do a self-directed IRA. So I want to make sure we understand those. We're going to walk through step by step. How do you do these investments? So if I'm buying stock in an IRA at Fidelity, all I have to do is click some buttons and I have the stock. I don't have to pay a utility bill every time Apple just, has a utility bill, right? I don't have to worry about transactions. I don't have to worry about some of the questions some folks came up with after the last one, managing properties and stuff. You don't have to worry about those things with your traditional investments, but you do with an IRA. So I want to make sure that you're comfortable with how other people have done those by the end of this session. The final one is, and I didn't put it up here, is a lot of folks get discouraged and they say, Mike, I don't have a ton of money. I don't think I can make this work for me. So one of the things that's important to make sure people understand is there are different ways to finance or fund investments where you don't have enough money to do the full investment on your own or on your IRA's own. So there are some strategies and some structuring options that other people have employed that I'm going to share with you. And also I'm going to walk through how that changes how you manage and maintain the investments, okay? So I really want to give you guys some confidence by the end of this time. So again, light reading, Internal Revenue Code 408. It's really good stuff. But I'll summarize what you should probably know here. So IRA investments need to be held in your IRA's name. And again, these are just general rules that govern IRA investments. They're going to come up throughout our session here, so I want to lay them out now. Basically, the principle here is you are not doing these investments. Your business is not doing these investments. Your IRA is. If you've ever talked to someone at Equity Trust, there's a lot of times where we intentionally correct people's vocabulary because people will call in and say, hey, I'm looking to buy this property, and they explain this complex scenario that involves me, I, this guy, my aunt, my uncle, my dad, and at no point is the word IRA mentioned. So we have to understand, where does the IRA come into the mix? So your IRA is doing these investments, not you, not your business. So they're going to be held in the IRA's name. And the legal titling that's acceptable, you don't get to pick your own. Legal titling that's acceptable is Equity Trust Company Custodian, FBO, stands for the benefit of. Your name, IRA. You do have the option of using your account number instead of your name. Some people like to do that. Anonymity. If you're using multiple accounts, some people like to do that to distinguish between the accounts. But that is the legally acceptable titling for an IRA, okay? You need a custodian to hold the investments, to hold title. An IRA by law is a type of trust. So the analogy here would be that the custodian is actually the trustee, right? Now, I don't want you to use these terms when you're talking about the IRA, but I wanted to give that analogy for those that understand it, because the trustee can act legally on behalf of the IRA. But in an IRA, we have to take direction from the account holder, which is considered the grantor beneficiary if you want to use legal terms, okay? So basically what this means is we have to sign documents, but you need to tell us that those documents need signed. Make sense? The final is the custodian has to be a federally chartered bank or credit union or a state chartered financial institution. So Equity Trust is a state chartered trust company out of South Dakota. So that's why we say things like we're an IRS approved custodian. It's because we are approved to hold IRA assets under law. The reason I bring this up is I have a lot of folks that will come to me and say, hey, I want to be my own custodian. I read online that I can be my own custodian, and that's not the case. So I was talking to a guy. I was trying to find a way to put it nicely, and he says, I read I could be my own custodian. This guy's just fighting me on it, and I just started laughing. I said, Bill, you sound like a great guy. You sound like a nice guy, but you don't sound like a bank. You don't sound like a credit union. You're not one of those, are you? I said, no, I'm not. That's who you have to be. So if you're a bank, you could be one, right? So you need someone like Equity Trust to be able to hold these. What makes the account self-directed is who the custodian is. So Fidelity, if they wanted to tomorrow, Fidelity could say, hey, you can invest in real estate in your accounts with us. But it doesn't make business sense for them to do so because they have a pretty good business model of building these technological tools that allow you to click buttons, not talk to human beings, pay them a transaction fee, and buy and sell securities. And that's what most folks do. There's nothing wrong with that. But it doesn't make sense for their business to help you process a real estate investment in your IRA. There's more paperwork involved. It's more manual. It's not scalable for them. So you need custodians like Equity Trust who are purpose-built to actually hold those types of investments. So if you actually go to the IRS's website, they do say things like real estate are permissible in an IRA, but your custodian doesn't have to allow you to invest in it because there's more of an administrative burden. Throughout this session, I'm going to share with you, and I know Jeff did a little bit this morning, some of the technological tools that we've built to make that less of a burden on you and us as well, okay? So step one, now that you got your account set up, so find an investment. So you find an investment, you're putting this investment together, and the age-old question that I get so often is, can I do this with my IRA? So I want to teach you guys just a simple test to screen a lot of these things out. If you're putting an investment together, ask yourself these two simple questions. The first one is it an asset permissible in an IRA? All right, so for those of you who are in the first session, give me a couple assets that were not permissible in an IRA. Collectibles, life insurance. Anything else? S-Corp. See, look, someone's taking notes. I like it. So you could even sum this up and say, is this life insurance, collectibles, or an S-Corp? And if it's not, which usually it's not, you can proceed to question 2. Will my IRA transact with a disqualified person? Now, I'm not going to ask you verbally to shout out disqualified persons, but basically, as a refresher, these are your lineal ancestors, your lineal descendants, your spouses of your lineal descendants, yourself, your spouse, and any business majority owned by any of those folks. So kids, grandkids, nieces, nephews, etc., right? So ask yourself, will those people be transacting with my IRA? Will my IRA be buying something from them, selling something to them? Will they be leasing from my IRA? Will they be doing physical work on this property, which is considered a transaction? And if the answer is yes, then you shouldn't proceed as is with that investment in an IRA. Potentially talk to an attorney to see if you can do it differently. So to start the process, you need to request the funds from the IRA. You need to direct the investment. So if you have an IRA with a Fidelity or Schwab, how do you do that? You log into your account, you click some buttons, and you tell them, I want to buy 50 shares of Apple stock. and they do it. But unfortunately, it's a more manual process with this stuff. So in this industry, we've created this thing called a DOI, or a direction of investment form. And I know Jeff was kind of joking about it this morning. Our goal is to get rid of that form and actually have it be electronic. But basically what this is it's a form specific to the type of asset that you're looking to buy. So if you're buying real estate, you log into your equity trust account, you can click on real estate, and you could download a real estate direction of investment. And it asks you questions like, what's the address of the property, how much are you buying it for, etc. That's just basically you giving us information on what you're investing in. We take that in, along with supporting documentation. Supporting documentation for real estate could be a purchase agreement, right? So you get the purchase agreement drawn up, and again, in the name of the IRA. So purchase agreement says equity trust company, custodian, blah, blah, blah. And you sign that purchase agreement, and you send it to Equity Trust, along with the direction of investment. Now, what's really cool is you're about to be able to do this all online, right? I know we demoed part of the process for you this morning, but basically you could just log in, tell us some pieces of information under the real estate section, upload that purchase agreement, click submit, and we have what we need to start your process. So you just need to tell us, hey, I'm looking to invest in this. Our goal is to be able to do that for pretty much all investments and have you be able to do that all electronically should you desire. So I'm going to share with you guys some common pitfalls. So common pitfalls, and usually these are paperwork related. The investment isn't titled to the IRA. So someone's investing into a private company, like a crowdfunding startup type of scenario, and they want to use their IRA, but everywhere on that agreement, it just has their personal name. It's not titled to the IRA. So what happens in that case is you send all this stuff to Equity Trust. We review it after a day or two or three, depending on what type of transaction it is. We'll talk about that. And then we get back to you and say, hey, this documentation doesn't work. You need the title of the IRA in here, and now you need to go back to an attorney and have them draw up new legal documents. But if you had called first and got this information, you might have avoided that headache, right? Blank or missing information. That's dangerous. We all know that, but it happens, right? So direction of investment forms or even, God forbid, legal documents have blanks on them. Can't proceed unless all that stuff is completed. Missing signatures and dates. If you use a paper direction of investment form, you have to sign every single page for security reasons. And a lot of times things are missing or people don't date. And anyone who's ever signed a legal document or worked with an attorney knows that you got to have this stuff, right? Supporting documents are missing, right? So you send in a direction of investment form for a piece of real estate, but there's no purchase agreement that tells us that you're actually purchasing this property. So we can't just blindly send funds out, right? So if you have these things, you're going to have a little bit better experience. And the final one is insufficient cash. Sometimes this happens when folks are moving funds in. So those of you who sat through my first session, we talked about how it takes sometimes a week and a half, 2 weeks, 3 weeks, 4 weeks to get your money from your current financial institution into your Equity Trust IRA. And if you have an investment ready to go, you don't want to wait for that. But we have folks that they'll put the investment together, they'll send us the documents, but we can't do anything. We can't finish processing that investment because we don't have funds to send out. These are things that have held other folks up in the past and have given them maybe not the best experience that can be avoided, right? Set your account up ahead of time. Make sure you have funds in it before you go do an investment. You know, we've built a lot of tools to make it easy, but you also have the ability to invest in pretty much anything that you would want to invest in inside an Equity Trust account. I mean, if you want to keep your funds parked in mutual funds, you can do that with us. If you want to invest in digital currencies, you can do that, right? If you're going to do this, for a lot of folks, it's a lot easier for them to just manage one account rather than having accounts multiple places. So if you get it set up ahead of time, you may avoid that last one. There was a gentleman who got started, and had an investment he wanted to do. It was a private equity investment. And he submits a private equity direction of investment to us. Let's just say it was May 15th. He sends it to us, and on the direction of investment, it says, we also need this supporting documentation. None of that was present, right? So we get that documentation in, it gets sent to a processor, and after about a day, we reach out to the gentleman and say, hey, we need the supporting documentation. He says, okay, I'll get it. 2, 3, 4 days goes by. Finally, he gets supporting documentation to us, and he has a list of things that we're supposed to have. And he gives us, out of the 4 documents, he gives us 2 or 3, right? So we can look at those, but then we go back to him within a day and say, hey, we still need these other documents in order to process your investment. 2 or 3 weeks goes by, and we haven't heard from the guy, and we've called him 3, 4 times, sent him emails. Finally, after 2 or 3 weeks goes by, he sends in those additional documents. Let's say this, I think this was like maybe the 12th of the following month. He sent those in at like 3 o'clock in the afternoon. 8:30 in the morning, the next morning, he calls his sales rep that helped him open up his account at Equity Trust and says, man, you guys are terrible. A month ago, I started this investment process, and you guys still haven't sent my funds yet. And he wanted to complain and threatened to escalate this up the chain when we didn't have all of our documents until a month after he started the process, right? So if you hear folks that say, hey, look, this happened, it took a month for me to get my money out of Equity Trust, but we don't have all the facts when we hear things like that. It's these things that can hold up your investment and create a bad experience for you. And we don't want you to have that bad experience. Doesn't matter whose fault it is, we don't want you to have that experience. So that's why I want to share this stuff with you guys now to set you up for success. This stuff can be really powerful for you, so I want to make sure you have the best experience possible. So what happens is you send the documentation to Equity Trust, an investment processor actually gets assigned to your investment. You get that person's extension, you can call them directly with any questions, you can log into MyEquity, and you can actually see the status of your transaction. If anything's needed, you'll get that in MyEquity, and your investment processor will call you and email you. But once everything is good to go, we send the funds out. Your IRA owns the investment. If there's any legal documents at that point, any final documents like a deed, for example, you can send those to Equity Trust to settle the asset. We have a safekeeping room, but we keep record of all this stuff. That's one of the cool things about investing in a self-directed IRA is you don't have to keep the same level of records you do for your business that you have outside of the IRA. We keep all those records for you, which is nice. So your IRA owns the asset at this point. Now the question is, how do you operate that investment? So you own a rental property. How do you operate the rental property? Using the IRA. You own a note. You just did a loan. How do you start receiving payments on that loan? How do they get into Equity Trust? What if I have to pay bills? What if I have to pay for insurance? How does that work? So let me take you guys through that. Before I do that, we got one more principle. Arm's length investing. And this kind of came up a little bit with property management conversation we were having. So you don't have to worry about this so much when you're buying stocks and mutual funds, right? You don't have to worry about keeping arm's length and worrying about doing things like physical labor on a stock. But if you have real estate, you do have to worry about those things. And these are things that are set in the tax code that you shouldn't be doing with an IRA investment because your IRA investment should be at arm's length. So when it comes to a rental property, you or any disqualified person should not be doing any physical work. So if repairs need to be done, it should be a third party that's not disqualified to your IRA. And then your IRA is actually going to pay that person for their services. It doesn't have to be a licensed contractor. If you really wanted to, you could pay little Timmy down the street to mow the grass, but the funds need to come from the IRA. Also, where this comes into play, I get the age-old question, Can I manage my own properties? And my follow-up to that is never a yes or no. I then ask someone, what's your definition of managing? Because it's different for some folks. And if your definition of managing is, yeah, I find the tenants, I screen for the tenants, I locate the properties. If it's administrative things, brain work, you're fine. But you draw the line at sweat equity. So if managing the property means that if the toilet breaks and someone needs to go there in the middle of the night and do repairs and buy parts from Home Depot, if that's your definition of managing, then no, you shouldn't be managing your IRA properties because you're not keeping arm's length from your IRA investments. So if your IRA does an investment, your IRA owns it. So your IRA is entitled to that income, so that income comes back to the IRA. So in the examples we were talking about here, Dorian couldn't just pocket, not that you would, seemed like to be a good upstanding citizen here. He can't just pocket the money from his dad's IRA investment as the rental checks come in, nor could his dad. And the IRA owns the investment, so the money needs to come back into the IRA. We're going to cover those logistics. If your IRA, invests in flipping a property, right? At sale, your IRA is going to get the proceeds from that sale. I want to draw a quick analogy, and I've done this a few times, to buying stocks, right? So when you buy stocks, you don't get a check from Charles Schwab that you need to go deliver to the New York Stock Exchange, right? So when you do an investment in things like real estate, even though it's a more tangible asset, you're not going to request a check from Equity Trust and then go take it to the title agency. You're going to instruct Equity Trust to send the money to the title company or to the closing attorney or whoever the case may be. The investment's done in your IRA's name, and the money goes directly from your IRA to whatever you're buying. The reason I make that distinction is a lot of people get confused and they start talking about, well, if I take money out of my IRA to do real estate, don't I have like an early withdrawal penalty? And that's not the case because you're not taking a distribution, you're doing an investment in the IRA's name. Everyone with me on that one? All right. Final one, and it should be common sense, you shouldn't derive any personal benefit from an IRA's investment. The spirit of an IRA is to do investing for the purpose of growing your retirement account. There's this thing, which I think I might have omitted, called the exclusive benefit rule, and it talks about just that. Any investment your IRA does needs to be for that purpose. So your IRA shouldn't be buying a property so that your daughter can have a place to stay in college. Okay, I gave the same example in the first one. That's a benefit that goes to you personally or a disqualified person. Okay? Another one is, I had a couple not that long ago call me and say, hey, we want to invest into this, I don't know if it was like some sort of vacation club, but they were raising capital, and they said, if we invest into this vacation club, not only do we have equity in the company, but we also get to stay in a property once a year as a result of that investment. And if your IRA is enabling you to get a personal benefit, the IRS would argue that that would be a prohibited transaction. So, think the transactions through. Make sure that the investment you're doing is for the spirit of growing your IRA and not to give yourself personal gain or put money in your pocket right this minute, okay? From an expenses standpoint, so let's walk through a couple. You own a property. You need to do some fixing up. You're going to hire a contractor. Contractor needs paid. How do you get money from the IRA? So we built this really cool tool called My Equity, which you all have heard about a few times today. And with the newest iteration of it, you could literally go to the job site, to the house, contractor's there. Yep, you did your work. Let's get you paid. I'm going to pull out my smartphone. I'm going to log into my equity account while he's, hanging out. And I'm going to go to online bill pay. And if I've never paid him from my IRA, I'm going to ask him for his information. And if he'd like, I could send him a check. Well, Equity Trust could send him a check. We could wire funds to him, but you also have the ability to select an option called ACH, which is kind of like direct deposit, and basically just ask for their information and click a button, submit, you have the confirmation, payment's on its way. Bill pays are processed in about 24 hours, and in some cases I've actually seen people have money, contractors have money in their bank account next business day. To be safe, let me say 48 to 72 hours. It depends on their bank and how they process. But you could literally just stand there using your smartphone and pay your contractors for the work that they've done on the property. Yeah, you could take a picture with your phone of the invoice and upload that when you go to do the bill pay if you'd like. Some people like to do that because it keeps financial records, which is really cool. And all of that stuff is available electronically. So if you ever need it, we can spit it out to you.
So utilities, things like that, you just put on ACH automatically?
Yeah. So utilities. Yeah, a lot of people actually just put that on recurring if it's a fixed cost. You can actually use online bill pay to do, we're going to talk about non-recourse loans. So your IRA takes on debt, pay the mortgage, right? You can just put it on autopilot. Every month on the 1st, we'll send a check, whatever you tell us to do. There's a lot of tools in place that pretty much customize this to your situation.
Your own LLC can't pay for repairs.
Correct. Your own LLC couldn't, for example, go to Home Depot or pay for repairs and then get reimbursed, because in order for that to work, your IRA would have to write a check and transact with your business. So you would need to find an unrelated party, basically, to do that. A different person's LLC. But as far as expenses go, all this is easily managed logging into My Equity. That's kind of what I want you to take away from this one. Now, in an income standpoint, a couple things I want to go through. Most important thing I can tell you with income, all income needs to be accompanied with a deposit slip. You're not going to go to your local bank and slap some cash on the counter and walk away, right? You want to make sure that they know it goes to your account, how much you put in it. Treat your IRA the same way. Specific to things like rental income, if you have 8 rental properties in your IRA and you want to be able to figure out what's being paid, what properties are producing, how much am I making, on the deposit coupons, it actually has the asset number. You can actually print basically coupon books from your My Equity, and the asset number, basically that income will be tied to that asset, and you could go into My Equity and say, hey, just show me the income for this asset, and you could see all the rent receipts, right? This is super important if you buy notes or do private loans with your IRA, because we need to know how much of that payment is principal and how much is interest, so that we can have correct asset values, because as you guys may know, you pay fees based on your asset value. There's a gentleman that I've been working with for years at Equity Trust. He's a client, and I felt so bad because a couple years went by, and it's reality, not everyone pays attention to every minute detail of their accounts on a regular basis. And they were asking me about fees. They're like, we seem like we pay a lot in fees for what we have in the account. Come to find out, the notes that they were receiving loan payments in on, they weren't sending deposit coupons in on. So we don't know to amortize that loan and reduce the face value. So they were paying fees based on the face value of the loan, when in reality it was worth like 1/10 of what it actually was. So we ended up reconciling with them and making sure that we had an amortization table, and we went back and updated the values. But if you guys are listening to me, you can avoid those headaches just by making sure a deposit coupon accompanies any income. The other things to think about is, from a rental standpoint or any type of income, it shouldn't go to you in the form of a personal check. For example, that you deposit into your own account and then write a check to Equity Trust. Now, I have people that actually will collect the checks from tenants, but the checks from tenants are written to the Equity Trust IRA. So all they're doing is they're just physically collecting the check, or it's being mailed to them, and then they take that check, pass it on to equity trust with a deposit coupon. If you have a property manager, they do that for you. If you have a loan servicer, they do that for you. That's the other thing to bring up is that, equity trust isn't going to be making collection calls on your behalf, right? So if you have a tenant who's late, if you have a borrower who's late, that's between you and the borrower. So that's why a lot of folks like to have those third-party servicers to handle those types of things, because we're not going to do that, and some of you guys probably don't want to do that either, right? So there are professionals that do those things. So I'm going to walk through a transaction with you guys. I chose this transaction. This gentleman was our investor of the year, I think 2014. I love this story because this dude lives in Michigan and bought a property in South Carolina and never traveled to South Carolina. He bought it all from the comfort of his home using his self-directed IRA. That doesn't mean he bought it sight unseen, though. So I'm going to walk through how this works logistically. So this is Arnold. This is his story. Arnold's not up there. But Arnold figured out that he wanted to invest in the Hilton Head, South Carolina area. Found a property that was actually going up for auction, I think, for the third time in 6 months. He placed a bid in his IRA's name. He won the auction. The auction paperwork, he forwarded that on to Equity Trust and did a real estate direction of investment form. Since this was a few years ago, he's filling that form out either on computer or by hand and sending it to Equity Trust, fax or email, right? So Equity Trust sends the funds to the county or whoever it was to, and now his IRA owns the property. Now, really interesting thing was this. Once he actually acquired the property, he put out an ad for real estate agents and folks in the area to potentially help him. And I think he put it out to like 100 people and got like 3 that responded, right? Because he wanted to see who's going to help him. So anyways, he connects with someone locally and has that person go in, take pictures. Because this was an auction, he had to buy the property without going into it. Take pictures, figure out what needs to be done. He also paid someone from his IRA using online bill pay to install cameras and a remote thermostat so he could control that from his computer in Michigan, okay? All of this was funded from his IRA. He pays contractors to do the work. Now there's cameras all over the property. If he's not actually going to be there physically, you think those contractors are going to do good work knowing there's cameras on them 24/7? So he did that because he had done his due diligence. Pays the contractors using online bill pay. Got fine? Perfect. If you talk to Arnold, he actually says, I used Equity Trust to pay contractors within 48 to 72 hours. Right? So this worked for him. So finally the property gets fixed up. He actually flies down to see the finished product and decides to turn it into a rental property. And actually, I don't have up here his rate of return, but he has, within a few years, this property has already paid for itself. And at last check, and he authorized us to say this, he had several properties in his IRA, but he was using that cash flow to buy additional properties. So the reason I tell this story is all this stuff that you're looking to do can be managed using the online tools that are available, okay? I want to talk about 2 other things in our last 5 minutes together. There's additional ways to structure investments. Co-investment or partnering is one common one that we see. The other one is debt financing. I'm not going to go into great detail. From co-investing standpoint, multiple parties could be involved in an investment. So if you're here for the first session, there was a young lady named Susan that I gave a story of. She didn't have enough money to fund a $160,000 loan that a real estate rehabber wanted to do, but she enlisted other people, and between the 3 of them, they were able to fund this loan. So your IRA doesn't have to have a ton of money in order to do an investment. Your IRA can actually buy part of an investment. Now, some people have asked me this, and they came up afterwards, so I'll bring this up for the group. One of the most common things that we see is people co-investing on things like real estate. So some of you may have heard the story of Gary and Jan, which I think are actually doing this session over here right now. Between the two of them and their daughter Brittany, the three of them have Roth IRAs at Equity Trust. And their daughter Brittany, when she started her Roth IRA, was like 14, 15 years old. So she didn't have a ton in it. And I always tell the story of a property that they bought for about $300,000, put $300,000 into it, and sold for $750,000. Brittany's IRA at age 15 took part in that investment. Her IRA doesn't have $750,000, but her IRA had enough to fund 3% of that investment. So what happened was, from a logistics standpoint, they structured it to where her IRA is going to own 3%, Dad's was going to own 51, and Mom's 40, whatever's left. Okay, that's irrelevant. So when they put down payment down, they split the down payment. I think it was like 55, 42, and 3. So 3%, Brittany's IRA wrote a check for 3% of the down payment. Contractors put money into contractors fixing up the property. Her IRA funded 3% of those expenses and those repairs. And then on the back end, her IRA got 3% of that 750 plus. So your IRA doesn't have a ton, have to have a ton in it to make this work. The key thing to take away is, you guys have heard me say you cannot transact with a disqualified person. And I'm talking about a family that's doing this. And the reason it's not disqualified is they didn't transact with each other. They jumped into the investment at the same time. They invested as tenants in common with undivided interest. And the courts will tell you, if you invest as tenants in common, you are individual investors buying a percentage of that investment and are responsible for that. It's kind of like thinking like you're in a swim lane. Their IRAs didn't send money back and forth between each other. Hey, my IRA is responsible for 3%. Here's my 3%. Oh, we got money coming in. Here's my 3%. Okay? So there are ways you can structure things like this. I'm going to hold questions because I have like 1 minute left. Well, according to this, I have 3, but we'll go in the middle. I'm going to talk real quick, a couple other things. Entities can be used. So if you have a bunch of investors coming together, you may be able to set up an LLC, but per my conversation with Dorian, it may not be in the best interest of someone who has their IRA involved to manage that LLC, so keep these things in mind. You'll hear more about this weekend. Joint venture agreements. See a lot of times where folks are using their IRA to invest alongside non-disqualified persons. I find the property, but I don't know the real estate business, so I'm going to find the property and put up 75% of the money, but I'm going to shadow you, Mr. Experienced Real Estate Investor, and you put up the other 25%. We'll split it 50-50, right? Joint venture agreement. So those things are possible because you're not disqualified. Okay, all these things are possible, and we could talk to you guys more about this one-on-one. The final thing to cover with you guys is debt financing. Now, there's a couple lenders out here that you can talk to for more details, but your IRA can take on debt. It needs to be non-recourse, which means you personally cannot guarantee this loan. Also, an IRA cannot be used as collateral for any loan. So the only security that the lender has is the property itself. So these loans are based purely on the merits of the investment themselves. This can be hard money lenders, could be private lenders, could be banks, as long as it's non-recourse. I tell folks this all the time. There's no such thing as a non-recourse lender. It's a non-recourse loan, and it's up to the lender to decide if they want to do a non-recourse loan. What you need to know, though, is if your IRA is going to take on debt, your IRA may have to pay a tax on a proportion of the profits that are derived from that debt. So if I'm putting 50% down on a property and financing 50% of my income from that is tax sheltered. The other 50%, I have to file a special tax return for my IRA called a 990-T and get to deduct depreciation expenses to see if my IRA owes any tax. It shouldn't deter anyone from doing this. It's just something you need to know. There are resources available to help you out with that. So I'll leave you with this. The final thought is, we talked about a lot of different ways that you can make these things work. And there's a lot of different ways to structure them. And the goal is to create as many tax advantage dollars as possible. So in the scenarios I gave you, there's a lot of folks that utilize multiple accounts to actually execute these investments. And here's the cool thing. If all of these accounts that you have, let's say you started a educational savings account for a kid, $2,000, and you're buying a house for $50,000. If that Coverdell Education Savings Account just buys 4% of that property, $2,000, it gets 4% of the benefit and can grow from it. But if all of the investors on that investment are equity trust accounts, it's really easy from a logistical standpoint, because that income that comes in, the tenants that pay checks that come in, the borrowers that pay checks, they only have to write one check payable to equity trust for that asset, and then we'll split it into the different accounts. So we have a lot of tools built to make this easy for you guys, no matter how you want to structure this. So I'm up on my time here, guys. We're going to be here all through tomorrow, answer questions, help you guys figure this stuff out, but hopefully this started to clear some things up for you. Thank you for your time.